Morning Trade Live. JPMorgan Chase announcing today that it is going to make direct investments of up to $10 billion over the next 10 years in companies in the following areas: defense and aerospace, AI and quantum computing, energy technology, including batteries, and supply chain and advanced manufacturing. The money is part of a broader effort dubbed the Security and Resiliency Initiatives, in which JPMorgan said it will finance or facilitate $1.5 trillion in funding for companies it identifies as crucial. JPMorgan Chase and other big banks kick off earnings season tomorrow morning. Let's just take a look at where things stand for some of these financial names as we look ahead to these all-important report cards. JPMorgan Chase up 2.5%, Wells up 1.3%, Citigroup up 2.5%, and Bank of America is up 0.8 this morning. Let's go inside out on bank stocks ahead of earnings season. Joining us now is Alexander Yokum, who is the Senior Vice President over at CFRA. So there's a lot of ground to cover when you look across the financials right now. I'm just wondering, if you take it up to sort of 30,000 feet, what your sort of broad outlook is for this season. I mean, as far as the momentum that we saw last season, can they keep it up?
Yeah, I would say broadly, we are quite optimistic. We think that loan growth is going to accelerate. Loan growth has been relatively weak, in the past, given elevated interest rates. And then, of course, in April with the tariff tensions. But with those tensions, coming down, albeit Friday, we had a little uptick, but generally speaking, coming down, we do think loan growth is going to accelerate, so that should be a positive. And then with some Fed rate cuts, there was one last quarter, and then we think there'll be more in the fourth quarter. That should add positivity in terms of net interest margins with lower deposit costs for banks. And then there should be benefits from areas like investment banking and credit quality, an area which many were concerned after April. That hasn't really materialized. We think credit quality will be stable or even improving for many banks here in the third quarter. So overall, we're pretty optimistic about this quarter. And although there have been some, concerns with credit and economic weakness, generally speaking, we think those will be one-offs. But overall, for the industry, we think it's going to be quite strong.
Okay, so they perhaps can keep up the momentum. I'm just wondering, as far as the consumer is concerned, I mean, we've heard some companies talking about sort of the bifurcation, the dispersion we're seeing across the consumer as far as those trends, how they're spending, etc. They are worried as far as the sentiment surveys are concerned about prices and also the slowing labor market. What are you likely to hear from the banks? Because it's almost like last season, or at least with every season, arguably, they sort of set the tone as far as the health of the consumer. And last season, they didn't seem to be too worried.
Yeah, so, you're definitely right. There's a lot of negative headlines about the consumer, especially the lower end. But what we're actually expecting is executives to basically say, you can't really trust headlines. You can't even trust what consumers are saying. You can only trust what consumers are doing. And what consumers are doing is they're spending. So we actually think it's going to be a pretty positive view. Even the low end, we think it's going to hold up decently, at least for banks in terms of their credit quality and such. So despite all the negativity, we think you should look past the headlines and look at the actual data. And the actual data, we think for most banks is going to be even improving, including credit cards. Credit cards have gotten a lot of attention with record balances and some thinking the consumer is stretched. But if you actually look at credit card balances adjusted for inflation, they're actually down over 20 years. And generally speaking, if you look at the amount of consumers' income that's going to debt payments, that's also down. So we actually think the consumer is in pretty good shape, although, their sentiment might be low, what they're actually doing in terms of spending. I mean, look at vacations and such, people are still spending.
Yeah, look, follow the money. And in the absence of some of the government data, no doubt we'll be looking at these earnings for just a bit of a barometer check, a temperature check on just exactly what consumers are doing right now, how they're really feeling, as you say, with regards to the numbers. Look, you could break these down, these bank earnings, in so many different categories. Obviously, here in the New York Stock Exchange, it's just another week, another IPO. So there certainly seems to be some deal making going on as far as trading is concerned. I'm just wondering, what you expect to hear as far as what we're likely to get from the big banks versus some of the regional banks.
Yeah, so for the large banks, definitely a fee income story. So that should be the delta there. Fee income should be quite positive. In terms of the regulatory environment, it's improving substantially. Even in M&A, right? We're seeing a big increase. You mentioned IPOs. We're seeing an increase. So we think capital markets activity is going to be really strong for the big banks. And then for the smaller banks, it should be more of a net interest income story. There had been some pressure there, given the elevated rate environment. Some of the regional banks hadn't performed very well. Obviously the collapse of Silicon Valley Bank didn't help there. But for this quarter, we think there should be a bit of a turnaround with loan growth accelerating for the industry, with deposit costs coming down. There should be some improvement for them. And then for both large banks and small banks, we think an improving capital environment. So generally speaking, there was an expectation that capital levels would be increased, so banks would have to hold more capital. But instead, what we've seen is that's gone down. So if you look at this year's stress test, we actually saw capital requirements come down for a majority of banks. So those were the large banks. And then next year, the small banks should also participate, and we think capital levels will come down. So now banks have excess capital. So we think they're going to lean into loan growth where there is. And then if there isn't enough loan growth, they should lean into share buybacks, which should be a benefit to the stocks because there'll be that bid there. So overall, pretty positive for both sides.
Excellent. Great preview. Thank you so much for your time, Alexander Yokum, Senior Vice President over at CFRA. Appreciate your time. Let's trade it now with Tom White, who is the host of Fast Market. Very good morning to you, Tom. So as we look ahead to these earnings, how are you looking at JPMorgan Chase as an example trade?
Yeah, a lot of the banks, as far as movement goes post-earnings, are kind of muted on a quarterly basis. They don't have that high of a beta as maybe some of the other names in tech and some other areas in the market. So JPMorgan expecting a plus or minus 4% move in either direction, just over $12 in either direction. So I looked at a strategy that I don't know if it's going to go higher. I don't know if it's going to go lower, but maybe it goes about that one standard deviation, maybe up to $15 either way. So I looked at a double calendar position here where it gives me exposure to the upside and downside based on that one standard deviation move that the option market's pricing in. So I went out to the October 24th weekly cycle. So 11 days to expiration. We're going to buy the out of the money 320 call, and we're going to buy the out of the money 290 put. And then we're going to sell those same strikes in the near term, October 17th, monthly options that expire in 4 days. So you're creating this double calendar position, 320 strike call, 290 strike put, 1 week wide. You're paying roughly about $1.70 debit for exposure to the upside and the downside. So there's your risk on this trade. You've got break evens between about 280 and 330 on the upside for this stock to remain in to be potentially profitable. What you don't want it to do is to sit right here where it's trading about 307. You don't want it to go up to 340, or you don't want it to go down to 280. You don't want to have one of those outsized moves. You're only paying $1.70 debit. There's your risk. Apex of profitability at or near either one of those strikes at 290 or 320, but you've got a nice wide range. You're buying about a 40% implied volatility on aggregate in the October 17th options, selling about a 54%. So that dispersion between implied volatility levels lowers the entry point for this double calendar position where you just need a move.
Okay, a good look at JPMorgan Chase, and switching gears to Goldman Sachs. You've got a sort of more neutral to bullish example trade for us on that name. Talk us through that, Tom.
Yeah, stocks pulled back about 5% from those recent all-time highs. Option market pricing in a plus or minus 4% move in this one, too. So I looked at something a little bit more passive. You can still take a directional bias. Going out to the October 17th monthly options that expire in just 4 days. Really short-term positioning. We're going to sell an out-of-the-money neutral to bullish put vertical here. We're going to sell the 760 strike put and then buy the 750 strike put, so a short $10 wide neutral to bullish put vertical. You're going to collect roughly about $250 credit on that. That's what you can make, $250 with $750 in risk, but it takes your break even down to $750 to the downside over the next 4 days. That's about 3.6% below the current share price in there. And you've got a probability on that short strike, on the 760 strike, of being out of the money of about 70%. So you've got that higher probability of success on this out of the money, bullishly directional, but also neutral.
Great stuff as always. Thank you so much for that, Tom White. That's a good look at the banks ahead of their report cards this week.